I'm sure you've seen this man before. He steps up to a podium, says,
Good afternoon.
Yep, we're talking about Jerome Powell, the chair of the Federal Reserve. He's not a politician, not a CEO, but his words alone can move trillions of dollars in a matter of minutes. Why? Because he controls one of the most powerful levers in the financial world, interest rates. Whether you're an investor, a homeowner, or just someone trying to afford groceries, what Powell and the Fed decide can have a massive impact on your wallet. So today, we're breaking down how the Fed uses interest rates, why they matter so much to the stock market, and how, in times of crisis, they can actually save it. Interest rates might sound complicated, but the idea is actually pretty simple. Think of an interest rate as the price you pay when you borrow money. Imagine you borrow $100 from a friend. If they ask you to pay back $105 later, that extra $5 is like the interest. The interest rate is just the percentage of the money you borrow that you have to pay extra. So in this case, it's 5%. Now, this idea of paying a little extra when borrowing money isn't just for people borrowing from friends. It's something that happens everywhere. Banks, companies, and even governments borrow money. And they all have to pay interest on those loans. The rate they pay depends on lots of things, like how risky it is to lend to them, or what the economy is like. But why do interest rates matter so much, especially for the stock market? Firstly, companies often borrow money to grow their business, to build new factories, create new products, or hire more people. When interest rates are low, borrowing is cheaper. This usually helps companies grow their profits over time. When companies grow and make more money, their stock prices often go up because investors expect them to be more valuable. On the other hand, when interest rates are high, borrowing is expensive. Companies may decide not to borrow as much, slowing down growth. However, interest rates don't just affect companies, they also affect people who invest money, including you. Imagine you have some money and want to invest it. You have two big choices: buy stocks or put your money into safer options like bonds or a savings account. If interest rates are high, bonds and savings accounts pay more interest. That means you can get good returns without taking much risk. So some investors might choose bonds over stocks, which can cause stock prices to fall because fewer people are buying stocks. But if interest rates are low, bonds and savings accounts pay less interest. Stocks might look more attractive because they offer a chance for higher returns, even if they come with more risk. This can push more investors into the stock market, driving stock prices up. And finally, interest rates also help keep the economy balanced. If the economy is growing too fast and prices are rising quickly, which is called inflation, the Federal Reserve might raise interest rates. If the economy is slow or shrinking, the Fed might lower interest rates to encourage borrowing and spending. This helps businesses grow and keeps people working. The Federal Reserve, or the Fed, is the central bank of the United States. One of its most important jobs is to control interest rates to keep the economy stable and growing. But the Fed doesn't just pick a number and say, "This is the interest rate now." Instead, it uses several tools to influence interest rates in the economy. Here are the main ways the Fed does this. Number 1. Setting the federal funds rate. The federal funds rate is the most important interest rate the Fed controls. This is the rate at which banks lend money to each other overnight. Banks need to borrow money sometimes to meet their daily needs, and the FFR is the cost of borrowing this money. The Fed sets a target range for the federal funds rate and uses tools like open market operations to keep it within that range. We'll talk more about that soon. When the Fed wants to encourage borrowing and spending, it lowers the FFR. When the Fed wants to slow things down, for example to fight inflation, it raises the FFR, making borrowing more expensive. Number 2. Open market operations, buying and selling government bonds. Here's how it works. When the Fed buys government bonds from banks or financial institutions, it gives those banks money in return. This increases the amount of money banks have available to lend, which lowers interest rates. When the Fed sells government bonds, banks pay money to the Fed, reducing the money they have available to lend. This can increase interest rates. Number 3. The discount rate. Besides borrowing from each other, banks can also borrow directly from the Fed at what's called the discount window. The interest rate the Fed charges banks for these loans is called the discount rate. Usually, banks prefer borrowing from each other at the federal funds rate because it's cheaper. But if a bank is in trouble or can't get money elsewhere, it can borrow from the Fed. When the Fed lowers the discount rate, it encourages banks to borrow more money, which means more loans for businesses and consumers. Raising the discount rate does the opposite. And finally, number 4, reserve requirements. Banks are required by the Fed to keep a certain percentage of their deposits as reserves, money they cannot loan out. This is called the reserve requirement. If the Fed lowers this percentage, banks have more money to lend out, which tends to lower interest rates and stimulate the economy. Increasing the reserve requirement reduces the money available for loans and can raise interest rates. However, in recent years, this tool has rarely been used, especially since the 2020 shift to 0% requirements for most banks. Now, you might be thinking, okay, this sounds logical, but too much theory. Don't worry, that's why I will make it more practical. 2008 financial crisis, one of the clearest examples of how the Federal Reserve steps in during a crisis to help the economy. This crisis started when big banks and financial companies faced massive losses, and some, like Lehman Brothers, collapsed. The stock market plummeted, credit froze, and the economy was at risk of falling into a deep recession or even depression. So what did the Fed do? First, cutting interest rates. The Fed's first move was to lower the federal funds rate. Before the crisis, this rate was around 5%. But as the crisis unfolded, the Fed cut it rapidly, eventually bringing it down close to 0. But just cutting interest rates wasn't enough. The crisis was so deep that banks were hoarding cash, afraid to lend, and people were too scared to borrow. So the Fed took even more aggressive action. It launched something called quantitative easing, which is kind of like aggressive open market operations. Instead of small, routine bond purchases, the Fed started buying massive amounts of government bonds and mortgage-backed securities from banks and financial institutions. When the Fed does this, it injects cash directly into the banking system. That gives banks more liquidity and encourages them to lend. At the same time, it helps push long-term interest rates lower, which is crucial for things like mortgages, business loans, and corporate investment. And finally, lending directly to banks and institutions. The Fed also made borrowing easier for banks by lowering the discount rate, the interest rate banks pay when borrowing directly from the Fed, and encouraging banks to use the discount window. This helped banks get cash quickly if they were struggling, preventing more failures. While recovery took years, the Fed's swift actions helped stabilize markets and gave the economy a chance to heal. So now you know interest rates aren't just some boring financial term. They're one of the most powerful tools the Fed uses to guide the economy and, by extension, the stock market.